Hi everyone, hope you're doing well. I just want to share some new backtesting results, specifically for CL. There's also been some changes. This time I also looked at wicks and also to the tick touches of the box. So previously I just looked at a close inside the box and then 2 consecutive closes outside. And I realized that over a certain sample, a lot of the trades I missed out on because on CL and probably also on all the other assets, it happens very often that price wicks in the box or goes to the tick and then sees a very big movement. And of course, I want to be able to catch those moves as well. And since we're considering price and time also, I thought that it's okay to also be more aggressive, with the entries. So take as many signals as you'd like, as long as there's good price or time alignment or both. So the biggest difference, of course, for this backtest is the entry signal. So just to show an example, previously we did only the close in. So after confirmation, price comes back, closes inside the box, and then we need to have 2 closes outside. And then we enter on the open of the third candle with our stop according to DRLens price clusters. This time, let's see if we can find an example. So for example, here's one. We see confirmation. Price then returns. Here you see that it touches to the tick, to the M7 box. And then after it touched to the tick, we wait for another 2 closes. So we don't count this close, but we do count the next one and the next one. So this is a close below and also a close below. And we enter on the open, but in this case, the risk reward was too low. So we went Anand style. Yeah, so here's a better example for a wick. No, this is not a wick, by the way. It's close in. Yeah, so here's a wick. Here you can see price confirming. This rejects the box with a wick. Then we see one close, another close, and here's our entry. So that's the entry signal. Then another thing that is different for this backtest is also that the stop loss is now behind the close or the open. So instead of the more complicated DRLens price cluster strategy, I was looking at the simple, the close and the open for CL specifically. So I realized that in ES, the close as a stop is not a very strong level, as price tends to wick deeper inside the box very often. So you get stopped out in many cases. But on CL, it's actually different. So CL typically, after you get a Goldfish entry, it directly moves to target without going for another retracement. So that makes the close or the open line, whichever one is closest, a very realistic and good place, to place your stop behind. And it also leads to a higher RR. So compared to like the DRLens clusters, the win rate may be a little bit lower because it's more tight, but the high RR is definitely increasing the results. So you can expect to make like 10 or 15 more R per 100 trades. And it's of course also very easy, simple strategy. The only thing that I utilize is just 3 ticks above the closest level of the box, like the open or the closing line. And the 3 ticks is very important because price tends to wick through it with 1 or 2 ticks, and I found that 3 ticks is the best margin to use. So another thing that I'm using is no false confirmations. That's still the same, and this time we are not entering any trades 20 minutes before the end of ODR, and we're also not entering any trades anymore after 2:30 during the RDR. And since we have more opportunities with the wick and the to the tick touches, we are limiting our risk to our loss per session. Another important thing is that it doesn't happen very often, but after confirmation, sometimes it confirms with a wick and then closes inside the box. What we want to see is price closing outside the box first and then back inside, or reject with the wick from outside the box, and then it's valid. So it first needs to close outside. So the total results, the backtest mainly was 100 trades, and they were taken from July till now, till yesterday, basically the 18th of September. And I just recorded every trade, so it didn't look at price or time, or well, I did look at it, but I didn't filter them out. So just to again evaluate, the importance of price and time. And for the regular standard results for the Goldfish, so using these rules here, we can see that there's a 0.9 average R per trade. That's the expectancy. So every trade that we take, we expect to make 0.9 R. The average winner is 5.2 and the best winner is 16.5, 100 trades, and the total R is 93.3. The win rate for this strategy is 31%. And you can expect to have 3 consecutive wins or 6 consecutive losses. It's quite evenly divided between ODR and RDR, a little bit more in the ODR, but yeah, you never know if that's a real effect. And now this is already like a very good strategy, because 0.9 average R is a lot more than most of the traders actually are making. And so, I'm actually very inclined to just follow that standard strategy, since it's already producing so much R and you don't even have to think about anything. But I also recorded time and price, of course, and I used percentages mainly for this. So this means that I'm just going to count the cluster wherever price the AMR is. So if you look at the lens, for example, you can see that, for example, let's say that the AMR was at 10.45, then it would be inside this cluster, then the Goldfish triggers. Then we're going to just record the count of this cluster, and we divide it by the total count here. So we would get 26 divided by 157. And I usually just calculate that with the calculator. And if I would plug it in, it would say 16.5%. And typically, like, the mode is going to be around 10 to 25% depending on distribution. And my hypothesis, of course, was like the bigger the percentage of the mode that the AMR is aligning with, the bigger the win rate is, and possibly also the RR in total, right? So then we could make a rule based on, we would want to pick clusters with at least 5 or 8% alignment, and it would make it much more mechanical than instead of saying like, oh, we just pick like a reasonable peak, because that's still maybe too discretionary. I don't know, but this is very easy to identify, especially during live trading. And I also did the same for the price clusters, but only for the median max retracement, because on the previous backtests I found that mostly the median max retracement was most significant in predicting win rate and R. Excuse me. And that it's very more reliable and easy, better statistic to use if we're just gonna measure how good the trade is that is in front of us, right? So now what we expect is if I you know if I sort them, from low to high percentage, we expect the lower ones to have less good results and here to be better results. And like you can already see it, like if you look at it from here, especially in this higher part here, you can see there's very few wins. Like here's a win, here's a win. This is like string of losses. Here's a win, here's a win, and here you see more winners coming in, and that's of course a bit higher up in the range. So right now it's sorted on price, okay? And once you go higher, you see that wins are more frequent. So that's exactly what we expect also. And well, you can see that maybe below 4% alignment in price, results tend to be not very, very good. And we're just isolating one variable. Like we're not looking at time, not looking at any other variable, just our standard Goldfish. That's how we defined it, and then just price. Now we can also do the same for time, of course. Here, gonna look at it again, and see that's maybe a little bit more divided than price. Let's say that we're gonna get everything until 5%. We see an average of 0.26, total 4. And if we look at like above 5, the average is 1. So there's quite a big difference. It's 4 times as much as below 5%. So that is, well, you can see that like even without any time alignment, it's already profitable. So that's interesting, but not that much, but still it's profitable. If you would go like from 8%, you see an even higher, so 1.22 compared to 0. So that is quite a big difference. And also what we expect, right? So just looking at what we have right here, you can already like form a rule where you can say, okay, price seems to be very important for CL. So we're just going to take trades that are higher than 4% alignment, right? So then if there's like 149 samples count in the total distribution, we're going to need to see at least 6 aligning with the AMR. So if we would do that, then we can like erase all the ones that didn't meet the criteria, and we can compare like the results on the dashboard. And you already see like very big improvements. Right now it's already the 108 R, average R is 1.5, which is 0.6 higher, like almost double. And the win rate is 38%. So not too much improvement in win rate, but big improvement in total R, average R. We can also do the same for price, basically. So let's say that we're gonna delete everything before 8%. Let's see the result first. So it's 93R, 0.9, 31% win rate. I'm gonna delete this. And this stays the same roughly. This is now a little bit better, and this is actually a bit lower. Right, so here we can see that time in itself in this current sample may not be too effective. If we would maybe go lower and say everything below 5%, we delete that. And we see that it's actually the same, also lower R and actually lower win rate. So that is somewhat of a interesting effect, and something that it's not really expected, as we think prices should perform better if it's aligned. But it looks like that in the case of CL, that price may be playing a much bigger role. If we're looking at alignment for the AMR and the win rate and performance of the Goldfish model. So that's quite an interesting effect. But it's of course only based on 100 trades, and the sample is also, I think, quite narrow because it's just 10th of July till 18th of September. So ideally, I need to go till January, so I have at least like 9 months of data. But I think it's going to be many trades, probably like another 300, something like that. And then we can see if it's still the same conclusion. But all in all, I think the setup by itself already does very well with these parameters, and we can improve it by just looking at price alignment. Never hurts to skip trades that don't have very great price alignment, and the time alignment also doesn't hurt it. It's not necessarily improving it that much, but it's also not hurting it. So being more selective is probably definitely the better choice, mainly regarding to price. So I also did a small initial test on dip alignment, and dip is like directional imbalances. And it's very simple. I would just look at whenever the setup occurs and kind of count like the directional imbalance that we see, and just whenever one direction is more prominent or more visible, I would note that. Like if it's with the price, I would say high alignment. If it's not with the price, I would say low alignment. And if it's like balanced, so there's an equal amount of up and down, I would just call it moderate or medium. It's just like no, just balanced. And I would also prefer like more recent. So if we get a trigger right here, and we see like these 3 directional imbalances, and here were some ups, I would say it's very high aligned, because it's like we're trading this direction, there's a lot of imbalances down, so I would say that's high alignment. So it's kind of discretionary. It's like the first test just to see if there's some effect, and I can already show you something. So we're just going to look at the high alignments, and here we see that the win rate is 35%, average R 1.3, so that is higher, and win rate a little bit, and average R a lot higher. And of course, you're going to compare it to like the most horrible one, which is the low one, see if we see a big effect. And for the low one, we see that it's 30% win rate, 1.2 average R. So if you compare the low and the high, there's like a 5% increase in win rate for the high alignments, and a 0.3 increase in average R. So it's clear that it's better, like a little bit better. So it also makes sense that it's just a confluence. Of course, it's not like end all, but you can see that if there's a high dip alignment, that you're gonna get like an extra 4 or 5% win rate, something like that. So it does seem very interesting. Like I also checked the moderate, but there's a very weird effect here where the moderate is not performing well at all. So moderate is just like when it's balanced or when there's no dips near the price action. So maybe that has a reason, but I'm not sure. Doesn't make a lot of sense to me. So I'm just gonna keep it in mind, but I won't do anything with it right now. So that's it for this backtest. I call the model the Squid. So the Squid is exactly these parameters and possibly also more price and time oriented. And I'm also going to look more into ES, see how it's performing with the wicks and to the ticks. And I think that next on my list is also the models. So I'm gonna be looking at trying to kind of make a system that encapsulates the models better, because it's so far it's been very difficult for me to get good results. Like if I would say, oh, the model is aligning with this trade, or it isn't, then I'm not getting a clear effect where it's when it's aligning that it's better than when it's not aligning. So that there's something wrong there, and it's probably in the way I assess it or record it. So but I have a new idea, and that's very simple. It's just like I'm not gonna look at the entire day, but I'm just gonna look at it compared to the previous session. So if I'm in the ODR, I'm just gonna look at the ADR, whether we are below it or whether we're above it, or whether price in the between the ADR and the ODR, or during the formation of the ODR and thereafter until confirmation has crossed the ADR midline. So that would be then a range expansion. So we're just gonna compare these to this one, and also the ADR to the RDR. So I think previously, like what we said is there's only like a range expansion if the ADR and the ODR expands, and is something like this, and then the RDR is this. So previously I would only say, okay, it's range expansion when we see exactly this, but now I'm already gonna call it range expansion when we see like a close above here, and then I'm gonna expect it to take out the highs. So once we break here, I expect it to take out this high here, and after it did that, I'm gonna expect it to take the low here. So that is going to be the expectation then for the model, for the range expansions. And for the upside and downside expansion is easy. Like we just want price to, or the model to be like this. So once we get this trigger, here we get our Goldfish trigger, we have not crossed the midline of the previous session. So I'm just gonna test that out, see if I can find some nice results for that, and hopefully get another 5% win rate on top of the existing model. So that's it for the update. I think for everyone who's trading the Goldfish, I would say like keep on going, like because September has not been the best month so far for Goldfish trades. I think even for this Squid model, like, and it's optimized like very much to the specifically to the most recent price action. And if you compare like August was amazing, and look at the R's. It produced 88 R's. This model in August, so that's crazy. And in September, like there's just horrible price action and produced only produced only 2.4 R. So still profitable, but very big difference, and just a small mistake or a model that is a bit less optimized would already be at a loss. So yeah, that's just the seasonality, I guess, with the Goldfish model, and I assume that better times are coming. So just keep on going, and I will keep you guys updated with any new changes that I make to the model. and also if I find something new interesting on different assets or anything like that. So, alright, that's it. Thanks for watching, and I'll see you in the next one.